Welcome back. Take a look at futures on this. The final trading day of February. Dow Industrials down 134. The Nasdaq down 53. The S&P lower by 17. Interest rates also higher this morning. The 10-year Treasury yield right now up 5 basis points, sitting at a level of 4.3%. 3 Federal Reserve officials say that the pace of rate cuts will depend on economic data, as you would expect. Boston Federal Reserve President Susan Collins and New York's John Williams both said that the first cut will likely happen later this year, while Atlanta Federal Reserve President Raphael Bostic says he's penciling a rate cut in for the summertime. Meanwhile, the January PCE is out any moment. We are 4 minutes away from this potentially market-moving report. Economists are expecting core month-over-month prices to be up 0.4% and up 2.8% year-over-year. Joining me right now is the Bear Traps Report founder and New York Times bestselling author Larry McDonald back with us. Larry, great to see you. Thank you so much for being here.
Hi, Maria.
What are you expecting from the PCE? And tell me how the institutions are playing this.
Well, first, I'm really excited. Our new book is less than 26 days away. It's When Markets Speak. It's up on Amazon, When Markets Speak. I really appreciate that, you having me on. But the big thing that we're hearing we have a conversation with the institutions around the world. Oil has been moving up, and gas has been moving up this year. And so there's a really strange divergence between CPI and PCE, which is kind of backward looking, and inflation expectations on the 5-year. Inflation expectations are rising at a very fast pace. The 1-year acceleration in inflation expectations are rising at the fastest probably we've seen in multiple years. And so inflation is now getting priced in because of oil. And if we have a tight market and the seasonality lining up here, we go into a bullish season for oil. Globally, you got right now France equities are all-time high, Japan and Italy, all-time multi-year highs. The last time we had that, oil was like $140 a barrel, right? So we're seeing this kind of like acceleration in potential oil prices into the election, and that's going to basically put the Fed in a very, very difficult spot.
Yeah, jump in here. Mark Tepper.
Yeah, Larry, look, I want to talk a little bit about our debt situation. I mean, we've got $34 trillion of national debt, as you know. But when you look at fourth quarter GDP, in the fourth quarter, our economy grew by $334 billion. Yet that growth cost us $834 billion in debt. So that's negative $500 billion. So we are financing our current economic growth by borrowing money, and we're not even getting a good return on investment on it. So my question to you is, given those numbers, do you feel like maybe we're beginning to skate on some thin ice?
Yes, and that's what the bond market, like the divergences inside the bond market over the last year are very strange. Like normally, like over the last year, we've had a recession risk, all these things, and bonds really never rallied substantially. And then in December, the Fed leaned, dovish, we rallied, and now we've given a lot of that back. And you're right. Remember, the team that's in the White House now was in the White House essentially during the Obama years when the Republicans basically put forth austerity. And so now they've kind of they're not rigging the election, but they've tried to basically slow walk so much stimulus in there, which is still coming out. And they're trying to prevent what happened in the last time around in 2012 when, Obama beat Romney, but, it wasn't as close. They didn't want it that close, right? And so now they've got a weaker candidate in Biden, and they're just going all in on spending. But the biggest thing I want to talk about is the regional banks, the super regionals. Yeah. The higher for longer with inflation puts the super regionals at big risk. We talked about this last February, Maria, and I'm going to make a call now. I think that the oil market and the tightness in the CPI, putting the Fed on kind of like a more hawkish plane, that puts the super regionals at risk over the next couple of months. I think we're going to see some real stress there.
Well, I want to talk more about that because that could be a trigger for the broader market, obviously create a real sell-off here. And your book goes through watching markets, When Markets Speak, which is out, launches March 21st. You're talking about the message of the markets and what you can learn from When Markets Speak, as you say. So I want to ask you about that because we're waiting on the core PCE index right now. What does that that say in terms of the market reaction to the PCE as we brace for what could be a hotter number for inflation coming out right now? Personal core PCE prices, as well as income and spending and initial jobless claims. We've got all the data right now. Right now, markets are mixed. Dow Industrial's down 52. The NASDAQ is up 12 points, and the S&P 500 is flat right here. Let's get to Lauren with the numbers. Go ahead, Lauren.
Okay, let me start with the numbers that I do have. These are numbers for January. It's on consumption and spending, income and spending. So personal income, much stronger than expected. Maria, a rise of 1%. Consumption in line, a rise of 0.2%. My eyes have been staring at the market's reaction. Month over month, PCE coming in now right as expected, 0.3%. That is in the month of January. Do we have the year over year number, guys? That's the number that the Fed pegs its inflation target to. The expectation is 2.4% for that. For core PCE, that came in at 0.4%, matching expectations. That is the highest in a year. Maria, guys, do we have 2.4% is the year-over-year number? Is that for core PCE or for PCE, guys? PCE coming in right on target, 2.4%. Maria, that is the slowest since February of 2021. This, again, is where the Fed pegs its inflation target. Core PCE, the other number that we watch, this is the annual number, also right on target. It came down a bit from December to 2.8%. That is the lowest since March of 2021. The market went from down 130 points looking at the Dow to down about 30 points looking at the Dow. Checking the Fed's reaction to all of this, because the market is now coming in line with what Fed officials have been saying. Maybe there's only going to be 3 interest rate cuts this year. I'm looking at the probability for June. 50% chance of a Fed cut in June stays at a 50% chance of a Fed cut in June as of this moment, Maria.
All right, Lauren, thanks very much. We got interest rates up, but off of the highs of the morning, with the yield on the 10-year now at 4.28%. Larry McDonald, your reaction to this core PCE number this morning?
Well, yeah, after the hot CPI and PPI, this is a relief because it's in line, because we had hot numbers, so the market was on edge coming into this, and the fact that it's in line will give you a little relief bounce for sure. But, the point that I want to make is that the super regional banks in the United States are underperforming the S&P, some of them by almost 50%. So the S&P over the last year is up 30%, and the super regionals are down anywhere between 10 to 25. And so we went back, decades. Whenever we've seen that, you got to be very careful, take some money off the table in the market, because if the economy is hotter or a little bit warmer than expected through the summer, and then we have this tight oil market, that's going to really push up inflation looking forward, not looking back. And that's going to really, then the Fed's going to be in a situation where they're kind of maybe forced to hike, but also they're dealing with very, very weak regional banks with commercial real estate, $1 trillion of maturities over the next year. So that puts that $1 trillion, if the rates go up, that brings more stress on the banks.
All right, so it's pretty much in line this morning. January PCE index up 0.3%, in line with the estimate, and core PCE up 2.8%, again, in line with the estimates. You're saying the regional banks have been trading poorly. I assume, given your book, when markets speak, that means I want to avoid the regionals, right? Is that the message here?
Yeah, you want to avoid the regionals for the next couple of months, because higher for longer basically puts the super regionals in very grave danger if the Fed really goes higher for longer.
All right, we'll leave it there. Larry, always a pleasure. Thank you so much.